Hi everybody, welcome to our monthly video post. In this, we are going to be talking about how one should navigate the current market down cycle. I have with me Mr. Arunagiri, who is the Chief Investment Officer of Trustline. Let me dive straight into a few questions which will be on top of investors' minds. Welcome, Arun.
Thank you.
My first question, Arun, is this. Trustline has been managing small cap funds for more than 17 years now. You would have seen many market cycles during this time. What do you make out of the current down cycle when compared to the previous ones?
Thanks, Govind. It's a very relevant question in the current context of correction. So it is in my view, it's always very interesting and very fascinating to see the current market correction from the prism of past cycles. Though no two cycles are ever same. And no one knows how this cycle is going to pan out. Only in hindsight, we will know how this cycle had panned out. Having said that, there's no harm in looking at the past corrections because it can give very important clues in terms of the broader directions for the market. So let's go back and look at the last 20 years. In the last 20 years, we had two strong bull markets. One in 2004 to 7. And the other one was 2014 to 2017. Both these bull markets lasted for about 4 years, straight 4 years in both the cycles. And, people would mistake that this was a single one-way run in both these cycles. It was not the case. In both these cycles, it was not a one-way run. You had a huge correction on the way in the bull market, right? For example, in 2004 to 7 cycle, mid of the cycle around May, June of 2006, we had this inflation scare, something similar to what is happening now, and the market corrected. Market underwent a very severe crack. In fact, at that point of time, May, June of 2006, small cap at the index level fell by 40%. And at the stock level, individual stock levels, the crack was close to about 60, 70, and 80% in some of the stocks. That was the kind of a damage once we saw in 2006, May, June. Surprisingly, when you look back, at the end of 2006, the market recovered most of the losses and finished the year with 14% gain when you look at the small cap index, and went on to deliver one of the best years in history in 2007 with about 90% plus returns in small cap index. Something similar happened in 2017 and in 2016. In mid of that bull market between 2014 and 17, early 2016, we had a scare of this Fed, US Fed monetary tightening in February of 2016. And market went through again, cracked. Small cap at the index level fell by about 17%. And at the individual stock level, the fall was closer to 30, 40, 50%. Similar thing, something similar to what happened in 2006. And it was a replay of 2006 again in 2016 and 17. The market went on to finish flat in 2016 and went on to build again one of the best returns in many of these years, with about 59% in returns from the small cap index level in 2017. So if past cycles are any guidance, it is very difficult to rule out a big recovery in the later part of this year and a huge momentum in the next year. At the same time, one should remember that no two cycles are the same. We really don't know how this cycle is going to play out. Only in hindsight we will know. Given those uncertainties and challenges, it is wiser for investors to stick to investing in their investing process and asset allocation and take a longer term view, especially in the Indian context because of the strong and medium and long-term fundamentals for India. That's what I would say.
That is a very good observation, Arun. So what I understand from you is that no two cycles are same. And even when the cycles play out, how it impacts various asset classes within the universe, that is large, medium, and small, are not the same. Thank you, Arun. My second question, Arun, is many are now worried about the scale of balance sheet reduction by Federal Reserve, the central bank, the US central bank, which has a profound impact on global liquidity. Can you draw from your experience of how similar rundown of Fed balance sheet from the past cycles, especially the one in 2018?
Yes, Govind, Fed has a very, very ambitious plan to run down its balance sheet. The sheer scale of rundown this time is going to be extremely huge. As per some estimates, Fed, people are talking about Fed starting with a rundown of about $25 billion a month, scaling it up to $95 billion a month, and finish the entire rundown by end of 2023. And the whole quantum one is talking about is close to about $1.7 trillion. Of course, this is a massive unwinding which people have not witnessed for many years. Of course, when comparison with what stimulus it pumped, relatively it may be not that big, because if you look at the kind of stimulus which they pumped since March 2020 during the pandemic, it was close to 5 trillion. Out of that, 1.7 is what people are estimating that Fed will shrink its balance sheet. But having said that, the scale is really big. Now, investors are genuinely worried when this kind of liquidity is sucked out of the market. Will FIs will ever come back to emerging markets like India? As all of us know, FIs have sold massive numbers since October 2021, right? Close to about $23-24 billion have gone out of Indian markets. Now, given the scale of reduction in balance sheet, will they ever come back? This is a very genuine question on investors' mind. This is precisely where we need to go back and look at the past cycle in which a similar rundown happened on balance sheet and see how FI's dynamics played out. You get a very interesting insight from what happened in 2018 and 19. Early 2018, Fed started doing this balance sheet shrinking, and it went on up to August 2019. And it is better to split this period into two, up to October 2018, and then from November 2018 to August 2019. Initial part of the time, they pulled out about close to average $30 billion a month. It's an average, it varied between 16 billion to 61 billion in some months. And the later half, they pushed up the monthly average to about $38 billion in terms of balance sheet reduction. In the first half, FIs did pull out money. They pulled out close to about $6 billion from Indian markets. But what was interesting is what happened in the later part of this balance sheet reduction cycle. From October, November, while Fed pulled out $38 billion a month, FIs started coming back, and they brought in close to $12 billion in those second part of the rundown. So if you look at that cycle, it gives confidence that it is not only FIs will come back to Indian market, but they'll come back with double the quantum of what they took back in the outflows time. So if you're imagining, they had pulled out close to about $23 billion. I will not be surprised the inflows after the dust settles down, the inflows will scale up much beyond this number when they come back. And there's no doubt about it if you look at the past cycles.
Great insights, Arun. What is also reassuring is that, as much as the money has been pulled out by FIs, the quantum of money has been pulled out by FIs, the same amount of quantum can return back in much greater or much higher volumes. Thank you. My third question is, there is a lot of talk about the onset of recession in the Western markets, especially in the US, because of the Fed policy actions and the ongoing Ukraine war. Given this, in your view, how should one navigate the current market?
Yeah, things are really tough, and things are going to be really tough and rough for the markets for next few quarters. There's no denying from that fact. And it's in this kind of market setting, it is easy for investors to get into, easy for investors to get completely frozen into inaction and take short-term actions. Like, fearing further downside, you start selling your good quality portfolio stocks. That's the last thing investors should do. I think the wiser thing is to take a longer term view and completely avoid the short-term macro noise. it's very important, going by of historical cycles, it's very important for investors to remember that no macro event, please underline, no macro event had any lasting impact beyond few quarters. And always, all past corrections, in hindsight, were beautiful buying opportunities. No exception to this. Given this, I think investors should take a longer term view, especially in the Indian context, given the broader economic recovery and given the China plus one tailwinds for India. Investors should use this correction to build a bottom up stock specific portfolio on a selective basis. Or if they're already invested, use this correction to top it up in terms of building further portfolio actions. That's what investors should do. And this is not time to panic. This is time to really build bottom up portfolio. And this is not time for timing the bottom. That's what I would say. Investors can use this fantastic opportunity given the longer term structural bull market for India. Also, while constructing the portfolio, investors should remember that the structure of the market is shifting from growth to value and from rewarding exports to domestic facing stocks.
So what I understand, Arun, is that what is important for investors to know is macro events have got a shorter shelf life, whereas fundamentals have got a longer shelf life. Fundamentals like macroeconomic fundamentals of India, as well as the fundamentals of stock specific companies. So that is a very good insight, and that's again gives you a lot of reassurance. Thank you very much, Arun, for your views on topics which will be confronting investors. We presume you would have found the session interesting and informative. Thank you all, and we shall meet next time with another video post.
Thanks, Govind, for an excellent interview. Thanks a lot.
Thank you.